Hey everyone, my name is Yvina and I hope you guys are enjoying this day. I would like to show you the differences between an employee without a home-based business versus an employee with a home-based business. For the first example, we're going to talk about an employee with no home-based business that makes $75,000, married, filing jointly with one child. As a reference, we're going to use the 1040. If you look at the 1040, you will see that it's broken into sections such as the personal information, the filing status, exemption, income, adjusted gross income, etc. What they make on line 7, which is $75,000, is carried over to line 22 because there's no extra income that this employee makes other than a W-2, which in other words, a job. This is the income that their taxes will be based upon before he gets any additional deduction. In the adjusted gross income section, he doesn't have any that's listed, so $75,000 is carried over to line 37. Now let's look at the second page. For line 38, it will be the same amount from line 37. Now we go to line 40. It's either itemized deductions or standard deductions. The government exempts X number of dollars from everybody's annual earning in terms of taxes. So in the year 2016, if you were single, $6,300 was exempted, $9,300 was exempted for a head of household, and $12,600 was exempted for a married filing joint. So since this employee is married filing joint, we will put down $12,600 for line 40. For line 41, you subtract line 40 from 38, the gross income, and put that down. So 75,000 subtract 12,600 is 62,400. There's exemptions for each person in the household. In this example, there's 3, the employee, their spouse, and the child. It states on line 42, if line 38 is 155,650 or less, which in this case it is because it's 75,000, multiply 4,050 by the number on the line 6D. This will give the family 12,150. For line 43, subtract line 42 from line 41. 62,400 subtract 12,150 equals 50,250, and that will be on line 43. So that lowered the taxable income to 50,250, and the income tax will be figured on that, which will be on line 44. So let's take a look at the same employee, married with one child, with the same gross 75,000, but have a home-based business now. If you go down to line 7, 75,000 still remains. But then we look down now at line 12 because we have another income stream, and notice we have a $50,000 loss. On line 12 it states business income or loss. So let's take a look at Schedule C. What is the Schedule C? The Schedule C is a tax form used to report items that are itemized. So if you own a business, you can use the Schedule C. I'm not trying to show you how to fill this form out, but I want you to understand a little of the process. Business owners can qualify for hundreds of deductions that employees cannot receive. Let's look at the title, Profit or Loss from Business. Obviously, the government is okay whether the owner makes a profit or loss. Line A through J is all personal information. Let's take a look at Part 1, Income. On number 1, it reads gross receipts or sales. This employee actually made $5,000 in the business. On number 2, it reads returns and allowances. He has none. So you subtract line 2 from line 1 and 5,000 will still be carried down. On number 4, it reads cost of goods sold. For number 5, it says gross profit. Subtract line 4 from line 3, so it's still going to be 5,000. On number 6, it states other income, including federal and state gasoline or fuel, tax credit, or refund. So in that case, it will still be 0. On number 7, it reads gross income. Add lines 5 and 6, and it'll be $5,000. So since $5,000 was earned, this employee will receive a 1099 as well. So let's take a look at part 2. Part 2 is where the expenses are documented. This is where you want to keep good records so it'll be easier for the person who do your taxes. That's why we have the cash flow manager. It makes it easier to keep track with everything, especially receipts. Some of the common deductions are listed: car and truck expenses, depreciation, travel, meals, entertainment, utility, wages. Line 13 is depreciation. You could take a percentage of the actual cost each year from any equipment you use for multiple years, such as cell phones, computer desks, etc. Line 16B states other. For example, interest on the vehicle you use for the business. For line 26 wages, that would be if you're paying your children or if you pay someone referral fees. If you add lines 8 through 27B, you will come up with $20,000 worth of expenses, and that will be put on line 28. Now, if you realize these are common expenses, so you're going to pay for them anyway: internet, mileage, meal, entertainment, etc. You won't deduct all of it, but you can deduct partial because it also becomes usage for business. Line 29 say tentative profit or loss. Subtract line 28 from line 7. $20,000 of business expenses, subtract $5,000 you made in the business, you'll have a $15,000 loss, and we'll put that on line 12. So if you have $75,000 for number 7, the wages, salary, tips, etc., and on number 12 you have a $15,000 loss, on number 22 it states combine the amounts in the far right column from line 7 through 21, which will only be those two amounts, so the total income will be $60,000. Line 7 and 22 was the same, $75,000. Now with the business, he earned $5,000, so he has some extra cash. But let's say we take the cash that we made from the business and use it to build our retirement for financial success. And let's get a tax deduction from the government. If you notice on line 28 from the 1040, it say self-employed, set, simple, and qualified plan. So we're just going to put $5,000 on there. So we'll put in the tax deductible retirement account. So now add that up, which gives you an additional $5,000 on line 36, and subtract that from line 22, and 37 becomes $55,000. You lower your taxable income by $20,000 from things you were going to spend anyway. So let's go to page 2. On line 38, amount from line 37 is going to be $55,000. On line 40, we're going to bring down the same standard deduction, married, filing jointly, so it'll be $12,600. Subtract line 40 from line 38, it will be $42,400. Line 42 will be $12,150. Line 43 will be $30,250. Now, with the first example without a home-based business, the taxable income was $50,250. Taxes owed at 25% would be $12,562, and the employee wasn't entitled to any deductions. With the second example, the employee invested $5,000, which was optional, in the tax deductible plan and got an additional $5,000 deduction, which made a total deduction of $25,000. The employee taxable income was only $30,400. So the employee ended up with $5,000 more in hand and $5,000 in his investment account. That's a total cash flow increase of $10,000. So if the employee repeated the process annually and invested half of his new annual cash flow of $5,000, which would be $416.67 monthly at an 8% annual rate of return, it will grow into 76,000 in 10 years, 245,020 and 621,000 in 30 years. So overall, having a home-based business is very beneficial because there's so many tax advantages out there. And if you invest your money wisely, that money will compound and will start working for you.